Hello everyone, welcome to Atomic ACCA's exam solving series, and in this video we are going to look at the pre-mock exam for June 2025 session for financial reporting. And here we are going to do section B, which will be the last part for our discussion in this particular question paper. So we know the structure would be we have three different case studies. Each case study will have 5 questions from it. Each question will be worth 2 marks, and just like how we told with section A, it's either you're going to score 2 marks or you don't score 2 marks. It's 2 or 0. So there's no partial markings over here. And again, you can expect, fill in the blanks, MCQs, match the following, anything could be there. So that's how it is, and we're going to solve the similar way. We're not going to use a rough paper. We're not going to use anything else. We're going to stick to the CB platform plus the what do you call the software calculator that you have, or I'm just going to use the calculator that's on my phone. We're going to stick to the simple calculator. All right, so let's begin with case study number 1. Just have a brief read over this. The requirements are for 16 to 20 Bollinger companies of finalizing its financial statement for year ended 31st December X6. There are 3 transactions which still need to be accounted for. 1st March X6, 31st December X6, 1st March X6. Okay. A sale was made for a high-tech medical scanner that included a 5-year support plan. Total sales price was 2.4 million. Okay, for me it was Scanner was delivered on the same date. Individually, the scanner would typically be sold for 2.1 and 5-year support plan. Okay, this is about revenue. Some product is being sold for 2.4 million, and scanner has a 2.1 value individually, and 5-year support plan is there for 400,000. Okay, done. 15 September, an industrial machine sold by Bollinger Company in Feb 20x6 was found to be defective. So it was already sold and then it's found to be defective. And several parts were replaced by Bollinger Company under the warranty. Okay, so not getting any extra money, you're just going and repairing for them. It's a warranty. Bollinger Company would typically sell the replacement parts for 120,000, but now it is under warranty, so you're not selling it again. Total cost for these replacement parts was 75,000. So this you'll have to incur as part of the warranty. Okay, done. 1st November X6, Bollinger Company entered into a contract for the sale of products for 300,000. Okay, Bollinger Company received 300,000 on 1st November X6. Okay. Bollinger Company has the right to repurchase these goods on 1st May 20x7 for 370,000. So this is like a sale and repurchase topic where the money you receive, you will have to treat it like a loan and all those things are there. So 300,000 you're selling it for, 370,000 you're going to repurchase. So it's at a higher value. So you'll have to do something with the finance cost and all. So all of this is related to IFRS 15. Okay. So everything is a revenue related question. Now we got a base idea from the case study. Now let's read the requirement and see. In most, some could be very theoretical questions. So you might not have to do any calculation. So sometimes you might end up feeling that why did I even read the stupid case study? Half of the questions didn't require it. But again, when you read the requirements over here first, and then you figure out where is this part of case study, then you come back and read the requirement again. That's going to take a lot of time. So to have a connection with the requirements that you have, just have a brief reading over the case study so you know where is this question related to. Okay, so whatever, let's start. In accordance with IFRS 15 revenue from contract, which two of the following criteria are required for an entity to account for a contract? Contract must be approved in writing, not necessary. Collection of consideration must be probable. Yes, only if you can get the money, you have to record a revenue. Good. Contract must have a commercial substance. Yes, correct. Contract must be associated with the bank. Not necessary. You can have cash transaction and you can have transaction in non-cash manners as well, where nothing related to currency is there. So that is also possible. So which two of the following was us? Two we found out. So that question is done. Under IFRS 15 revenue, how should the transaction price be allocated to all the performance obligation in the contract that are met over time? So when a contract is met over time, what you have to look at, you have to see when the work is being completed. That's how we generally do with deferred income. We'll put it over there. Then we'll wait until the work is being completed. When the work is completed, we will just clear it off. When it is things like, warranty and all, which we give for 2 years, you don't exactly see when the warranty is cleared. That is generally based on time period. If it's like a 2-year warranty, 1 year warranty time period is over, you must not have done any warranty service, but still that 1 year figure turns out to be a revenue for you. And after one more year, maybe you didn't do still any warranty service, but the whole deferred income now in the second year, whatever is remaining, will become part of revenue. That is based on time period. But generally for overtime revenue, what you have to see is You have to see when the work is completed, and I have to record the revenue accordingly. So based on the net realizable value of the components at the start date of the contract, nothing related to NRV or nothing about the information at the start date you have to look in order to record the revenue. So option 1 is out. Equally spread over the entire contract duration depends upon the revenue, but it's not always applicable. Allocated according to the total estimated cost of the component parts. Nothing has to do with cost of component parts. You can look from the cost how much is the progress completion percentage, but that doesn't have to be directly related to the revenue recognition. So or the transaction price being allocated to the performance obligation. So that's also out. Finally, revenue shall be recognized by measuring the progress of the completion percentage. This is by far the most technical term or the thing that you have to always follow with IFRS 15, especially when the things are met over time. You have to see when the work is being completed. Based on the progress completion, you will have to recognize the revenue. So, option D is right. Next one, for the sale of high-tech medical scanner was over here. What amount of revenue should be recognized for the support plan? So they told that over here individually there is a scanner and there is a support plan. So they need to know for support plan alone what will be the revenue, and they want to know it at 31st December X6 when the sale was made 1st March X6. So Jan Feb is over, so that means this is like a 10-month calculation that you have to do. What you'll have to do first, this 400,000 was the individual price, 2.1 million is over here. So individual total value is 2.1 plus 400,000, that's 2.5 million. So I have to find what is the proportion of this within the 2.4 million, and then I'll have to allocate it for the time period and find out how much is it for 10 months. Okay, let's try not to mess this up. How much was the time period? 5-year support plan. Okay. Mm, 5-year support plan. Okay, let's just note it down so that we don't mess it up. This is question number 18. Sub 5-year support plan. Value will be 400,000 divided by 2.5 million. That 2.1 plus 400,000. So that will be equal to how much? 400 divided by 2.5 million. That's equal to 0.16 percentage. Okay, that's like the proportion. And out of that, now I have to find it out of the transaction price of 2,400. So 0.16 into 2,400, which is 2.4 million, will be equal to 384,000. 384,000 is the value that I have to spread across 5-year support plan. So if I divided it for 5 years, I mean, if I want to find the 1-year value, that will be equal to 384 divided by 5, that's equal to 76.8. This is for 1 year. Now, out of this, how much do I need? I want from 1st March to 31st December. That's like 10-month period. Jan, Feb, March, April, May, June, July, August, September, October, November, December. Yeah, 10 months. So this into 10 divided by 12, that is equal to 76.8 into 10 divided by 12, that is equal to 64,000. So what is the answer we need over here? Revenue recorded will be 64,000. Next, to nearest dollar, right? Okay, so I didn't make a mistake. 64,000. Okay. Next one, which of the following statement is correct regarding the warranty work undertaken on 15 September? So warranty work was over here. What are the figures given? Cost of sales will increase by 120,000. No, what was 120,000? That is a sale price of the replacement part. So that has nothing to do with cost of sale. Out. Revenue will increase by 120,000. No, you're not selling that 120,000 item. You're doing it under a warranty coverage. So you're not getting any extra money for this. So that is out. Revenue will decrease by 75,000. No. Anything related to warranty cost or anything related to that, you have to include within cost of sales. So that is also out. Cost of sales will increase by 75,000, correct? Because that's the cost for replacement parts now that you're giving it to the customer. So that is part of your own cost that will increase your cost of sales. So that was quite direct. No complications over there. For year ending 31st December X6 match the amounts of Bollinger company should recognize in the financial statements for contract with option for repurchase. Okay, option for repurchase is this last paragraph. Once again, for year ending 31st December X6, match the amount that should be recognized in the financial statement. Okay. So when is the sale happening? 1st November X6. Year ending is 31st December X6. So November, December. So this is like a 2 month situation over here. First thing is I'm getting a 300,000 cash when I'm selling it. Received 300,000. What will happen? Debit cash 300,000, credit liability 300,000. By 31st December, what would happen? There will be an interest climbing on top of that 300,000 liability. Cash will not change. Liability will increase. By how much? The value that uh, when was the repurchase? 1st May 20x6. You have to pay extra 70,000 for this. 70,000 is the total finance cost. And 1st May 20x7. Okay, 1st November x6. So November, December, Jan, Feb, March, April. Don't count May till April only. Okay, so 6 months are there. Right, November, December, Jan, Feb, March, April. Oh yeah, 6 months are there. So 6 months is the total time period. Out of that, 17,000 is the finance cost increasing. November to December 31st, how much time period is it? 2 months is it? So I have to find 2 divided by 6, how much is 70,000, that interest, and then add it on top of the 300,000 liability, and that will be my final liability figure. So we'll just write over here. This is question number 20. First is debit cash 300k is there, credit liability 300k is there. Then debit finance cost, some value will be there, credit liability, some value will be there. Now what will be this value? It will be equal to 70,000 divide multiplied by 70,000 is for 6 months, so I need for 2 months, so into 2 by 6. How much will that be? 70,000 into 2 divided by 6 is equal to 23.33, equals to 23.33, and my liability will be 23.33. That means my overall liability by the year end will be 323.33. Finance cost will be this much, cash will be this much. Let's see what all information we have here. Finance cost will be 23.33. Next we need for revenue. Revenue will not be recorded. This is not exactly a sale, we are treating it like a loan, so no revenue will be there. How about SOFP? Cash we need 300,000, that is okay. And how about liability will be 323.33, that is okay. So this will stay blank, so maybe I'll have to put 0 with it. So that is our answers over here. This 200, what is 200,000? Okay, I don't know, that is something else, so don't bother that. So this is our calculation over here. So that question is done. So I think this was 16 to 20. So that was our section B, first question we're done with. Let's move to next question, project quant. Okay. Xillo company is conducting the following research project as of 31st March X7. Okay. Project Quantum. Project started on 1st May X6, 31st March X7. So this is not a 1 year time period. This is like 11 months. 1st April would be 1 year. So 1st May means okay, 11 months. With a total cost of 12 million evenly accrued till 31st December X6. Okay, so from May, June, July, okay, till December, it is 12 million, okay, whatever. On 30th July X6, that is midway through the year, 1st May, June, July. After 3 months, board members confirmed that the project fulfilled the capitalization criteria of IS 38. Okay. Project was completed and started producing revenue on 1st February X7. Year ending is 31st March X7. 1st Feb to 31st March is not 1 month, it is 2 months. So 2 months of amortization is there. Then the project is expected to generate revenue for next 4 years. Okay. Project Pinnacle. Project started on 1st August 20x6. That is also somewhere in the middle of the year. Cost of $25,000 per month was spent until 28th February X7. That is 1 month before the year end. Okay. When the project was cancelled. Okay. The unique equipment procured for Project Pinnacle was transferred for usage in other research projects by Xillo company. So even though it's a unique equipment they used for this Project Pinnacle, it is transferred for usage in other research projects. So this becomes part of the normal NCA for the company, and you'll have to record a normal depreciation on that. That is like a general question you must have seen in the exam kit as well. A similar question is there. Then 25,000 per month was spent and the project was cancelled. So basically, this was all a research expense. Even if the capitalization criteria was met, and if you have cancelled it completely, whatever you have capitalized, that will also go back to the SOPL as an expense. So that will be the accounting that happens here. Project Navigo, the project began on 1st February X7. Okay, 2 months before the year end. Cost of 45,000 per month were incurred until 30th September X7. So that is like in the next accounting period. The directors increased the budget to 70,000 to expedite the project completion due to the identification of a potential buyer on 15th August 20X7. Okay. So they increased the cost as well. Budget was increased. Success of the project was uncertain to the directors until this point, which means, the sale and not sale, what is it? Capitalization criteria was not met until then. So this is the information we have here. Everything is about IAS 38 research and development. In accordance with IAS 38, which of the following is the requirement for amortization of intangible assets, excluding goodwill? For amortization, what you need to have? You need to have a finite life for the asset, and then you have to do the amortization. That's it. No other thing. Irrespective of the useful life, intangible asset should not be amortized. False. They're asking which of the following is the requirement for amortization. Okay, so first one is false. Intangible asset should be evaluated for impairment annually without charging amortization. This is only for the indefinite life assets. We'll just keep it on hold if they're meaning for that or not. On a uh, basic sentence basis, that is wrong. Intangible asset that is having indefinite life should not be charged any amortization. It should be checked for annual impairment. We'll keep point number B on hold. Intangible asset should be amortized according to the expected pattern of future economic benefit consumption. Correct. Intangible asset should always be carried forward at the original cost, not to be amortized or impaired. False. So A, B, and D is wrong. Only C is correct. So that one is okay. Next one. Which two of the following statements are true in accordance with IAS 38 intangible assets? True. Okay. Two statements. Okay. Company must use revaluation model for intangible asset if revaluation model is being used for tangible non-current asset. False. Company should revalue all material intangible asset. Should revalue all material in, not necessarily should revalue. Like for example, let's say if you have a goodwill, you don't generally revalue it upwards. So that is also false. Then by default only C and D is the remaining option. But let's read this. Revaluation of intangible assets should be done only if there is an active market for such assets. Correct. You cannot mostly revalue most of the assets because most of it is like a one-off item. You'll not have an active market or high volume transaction happening for it. The initial measurement of intangible asset must be at cost. That is like the day one treatment of IAS 38. That is also correct. So C and D is the correct option. What is the total amount that will be charged to SOPL for 31st March X7 for Project Quantum? So as per Project Quantum's information that we have just brainstormed, there's a portion where research is happening, then there's a portion where development is happening, then there's a portion where amortization is happening. They're asking what will go to SOPL. So we need how much is the research figures, research expense, and we also need what will be the amortization. This is the figures we need. Now, what was the total cost that was incurred? 12 million, and it was accrued evenly until 31st December X6 from when? From 1st May onwards. So May, June, July, August, September, October, November, December. So for 8 months, 12 million was accrued evenly. So what was monthly expense? Monthly expense will be equal to 12 million divided by 8. How much will that be? 12 million divided by 8 is equal to 1.5, equals to 1.5. Now when was the capitalization criteria met? On 30th July they became little confident about the project. So May, June, July. So for 3 months it was research phase. So 1.5 into 3 months will be equal to 4.5 thousand. That is part of research expense. Now that is sorted. How much hence would be the capitalization expense? 12 million was the total, out of which 4.5 went into research. So remaining would be 7.5. 12 minus 4.5 is equal to 7.5 thousand will be for capitalization. Now this one I need. Now what I have to do, this capitalization, now I have to amortize it. What is the amortization criteria? Revenue, income, economic benefits should start. When is it starting? 1st February X7. When is the year ending? 31st March X7. So I need to find what is the amortization for 2 months, February and March. What is the total time period? It is for 4 years. So 4 years means how many months it will be? 2 months out of 12 into 12, 24, 36, 48. So out of 48 months, I need what is 2 months. Or you can find like this, 7.5 is the total capital expense. You have to allocate it over 4 years, divided by 4. Then you have to multiply with into 2 by 12. In either case, you'll get the same answer only. For example, I'll just show this. Amortization will be equal to 7.5 divided by, you have to do it for 4 years into 2 months out of 12 months. So if you look at the denominator, we have 4 into 12. What is 4 into 12 again? 48. So either you can do like this, first divide by number of years, then get what is the number of months, or you can just do directly what is, take the total number of months. It will be 7.5 multiplied by 2 divided by 48. Either ways you'll get the same answer, so we'll just calculate it. 7.5 into 2 divided by 48, that is equal to 0.3125. So 0.3125, if I add it with 4.5, how much it will be? 4.5 plus 0.3 will be something like 4.81, 4.8125. So we have the answer over here, 4.81. So that is our answer. So we're done with this question. Let's move to next one. Classify the following as true or false for accounting treatment for Project Pinnacle. Okay, that is this one. And Project Navigo. That is this one. Okay. Under IS 30. Okay. Project Pinnacle's cost should be treated as an expense in the SOPL for year ended 31st March X7. What was Project Pinnacle story? They cancelled the project. So yes, they have to treat everything like a expense. So that is true. Specialist device procured for Project Pinnacle should not be depreciated as it is exclusively used for research project. No, it is not exclusively used for this research project. It is exclusively used for all research projects. So it is just part of their normal NCA. They have to depreciate it. So they told here not to be depreciated. So that's false. Expenditure incurred for Project Navigo, that is this one, should be reported as an asset in the SOFP on 31st March X7. They told something that this project was uncertain until this point. What was that point? Something 30th September X, 1st February they started it, but they increased the, until they increase the budget on August or 30th September X7, whatever it is. But anyways, it's after 31st March X7. At some point they are getting successful, or they're becoming sure of the project, but that's after year end. So as at the year end at 31st March X7, even though on 1st February it is starting, whatever expenses incurred was in the research phase, so it is not to be reported as an asset in the SOFP. It will go as an expense to SOPL. So this is also false. So that one is also done. Okay, we have one more question. According to IS 38, which of the above costs should be capitalized as an intangible asset? Okay, in the year ended 31st March X8, okay, that is like next year, Xillo incurred the following cost: 350,000 in personal cost to maintain a computerized list of potential customer. Maintaining customers list and everything, this is like more like a maintenance cost, not like a capital expense for you. So option 1 is out, you cannot capitalize it. 1 only is out, 1 and 2 is out. So that means it's either 3 only or 2 and 3. Either of this should be the answer. That already gives the answer that 3 is definitely your answer. So now you have to only confirm whether 2 is an answer or not. So 2, 700,000 to acquire a domain name for selling Xillo company's website for e-commerce business. Domain name is something that you can capitalize because that's like an asset for you. Only you can have it. And this will also help in enhancing the economic benefit because that will allow you to run an e-commerce business. So 2 is also a capital asset, which means 2 and 3 is your option. Let's just read the third one. 3.5 million for a patent to enhance the manufacturing process with a useful life of 3 years. Okay, so that's a patent. That's a direct example of an intangible asset. So that's capital expense. So 2 and 3 is your answer. And with that, 21 to 25, we're done with the second case study. Moving to the final case study within section B. Okay, we'll just read this, get an understanding. Vance obtained a loan for 1,250,000 dirhams with a maturity of 2 years on 1st September 20x5. First maturity of 2 years. Okay, they obtained the loan on 1st September x5. Okay. Loan has an interest of 7% payable at the time of loan repayment. Okay. Loan was planned to be utilized to construct an office building, which will take 16 months to complete. Okay. Construction of the building commenced on 1st September x5. When did you take the loan? 1st September x5. And construction began on. Okay, I'm assuming this is something related to IS 23, maybe about borrowing cost. Building will cost 600,000 to construct on a piece of land that will cost 350,000. Okay. Buildings cost is over here. Land cost is over here. And some, okay, whatever. Then exchange rates are given. Oh, this is IS 21. As at 1st September x5, this much. Then for the period from 1st September to 31st December, this much. As at 31st December, that is, that is 1st October 20x5. What is happening on 31st October 20x5? For September is over here. 16 months building for September. Okay, whatever. As at 31st December x5, okay, we have that is year ending. Vance provides service to client in which the time period for fulfillment of performance obligations spans 3 to 5 years. Vance recently experienced some losses which may lead to the recognition of DTA for the first time since the company's incorporation. Okay. What will be the accounting model for the measurement of a 1.25 million dirhams loan in accordance with IFRS 9 financial instrument? They're asking whether it's carrying value, amortized cost, FEPL, FEOCI. Okay. They obtained a loan. So IFRS 9, what is the first classification? Whether it's a financial asset or a liability. When I obtain a loan, it means it is a liability. So first thing understood, it's a financial liability. Next thing I have to look at the business model. Am I holding till maturity or am I planning to trade with this? What is used over here? First thing is maturity is for 2 years. Why did I take the loan? This was planned to utilize for construction of the office building, which is going to take 16 months to complete, which means I am using this loan for the purpose of some investment or some expansion plans, and I don't plan on trading with this particular loan. That means my intention is to hold till maturity. That means I'm going to keep it under the default treatment of amortized cost. So story over. Next one. What will be the carrying value of the foreign currency loan on 31st December x5? Now this is amortized cost accounting. So as per that, you will start at the opening figure. Then you will have to, there's no there's no issue cost or anything given over here. So you'll have an opening balance of 1.25 million. Then you will have to add the EIR figure. Now EIR rate is not given anything, so we can assume that it's 7%. So we have to add the EIR on top of this. This will lead to a closing figure. Main thing, loan is a monetary asset, so you will have to retranslate it at the closing balance. So this is all the information we have. Let's start going through the solution. Question 27. Oops, what is okay? Question 27. Opening loan is equal to 1250 million dirhams, and the rate on that date is 2.5 dirhams per dollar. So since the rate, currency, what do you call? Yeah, the currency is same, dirhams and dirhams. 1.25 million dirhams and 2.5 dirhams is the rate. So when I divide it, it will be equal to 1250 divided by 2.5. That will be equal to 500. So $500 million loan it will be. Now what will be the interest on this? Interest will be 7%. So from the dirham side, it will be 1250 multiplied by 7%. Is it for the entire year? No, no, no. 7% is for, I'm obtaining on 1st September x5 and year ending is 31st December x5. So September, October, November, December. It's for 4 months. So 1250 into 7 percentage multiplied by 4 divided by 12, that is equal to 29.16667. So let's write 29.17. That is in, that is the SOPL item. SOPL items I have to retranslate at the average rate during that time period. It's given over here for the period from 1st September to 31st December. There's a average rate of again 2.5, so it still remains the same. 2.5, that is equal to 29.17 divided by 2.5 is equal to 11.668. So at 31st December X5, the loan in your dirham side will be equal to 1250 plus 29.17. So that is equal to 1250 plus 29.17. That is equal to 1279.17. And on the other hand, for the dollar, it will be equal to 500 plus 11.668. So that will be 511.668. Okay. Now this 1279.17 I have to retranslate at the closing rate. So 1279.17 in dirhams will be staying as it is, but now I have to retranslate at the end of the year period, that is 4 dirhams. That will be equal to, 1279.17, 1279.17 divided by 4, that is equal to 319,795. 319,000.727925. So do we have an option over here? 319,079. Okay, I had some decimals, so maybe that's why I made a mistake. But yeah, the final answer seems to be this one, 319,791. That is the closest answer we have. So maybe it's some rounding of error. So we're done with this question. Let's move to next one. Classify the following statements as true or false. The building should be retranslated at the closing rate as at 31st December X5. Which one is the building? The construction of the building commenced on 1st September X5. Building will cost 600,000 to construct, and this one. Now they're not telling anything whether it's IA 16 or IA 40 or whether it's cost model or fair value model. So by default, we can just go with the concept that this is a non-monetary asset and we do not have to retranslate it. When you'll have to retranslate to, convert to the fair value and things and all, when it is in the fair value model. So it's a non-monetary asset, so you don't have to convert it, so it should not be retranslated. False. Loan should be retranslated at the closing rate. That anyways we did, so that was true because that's a monetary asset. So that is done. Next one, in which two of the following scenarios will the revenue be recognized over a period of time in accordance with IFRS 15? Customer simultaneously receives and consumes all of the benefits provided by the entity as the entity performs the performance obligation. That's like a direct statement from IFRS 15. If you have gone through the textbook, you must have seen the statement. So that is done. Entity's performance or accomplishment does not create a resource that will be of economic benefit in the future. If there's no economic benefit in the future, means from the customer's point of view, they're not liable to pay anything. So there's no actual revenue happening over there. So that's out. Customer has a legal right to omit the promised offer of the entity after the agreement period, which means they can basically cancel the contract and they can just walk off. So in that case also I cannot record a revenue. So that is also out. Entity's performance creates or enhances an asset that customer controls as the asset is being created. First one and fourth one is basically a direct point under IFRS 15 over time recognition. There are like conditions they are saying, like according to IFRS 15, if any of these following conditions are met, then revenue is to be recorded over time. So these two are like direct statements from there. So that is like very straightforward theory question. Last one from section B. Accordance with IAS 12 income tax. Where did that come from? Okay, last deferred taxes. Which two of the following situations will lead to a non-recognition of a deferred tax asset by an entity? What was the statement given here? Vance recently experienced some losses which may lead to deferred tax asset. Hope you are aware of the concept of carry forward of tax losses. So when you carry forward tax losses, you have a deferred tax asset that you're creating, which you will utilize in the future. Now, they're saying that uh, we have to find out what will lead to non-recognition. Okay, that will not happen. Okay, there is a permanent difference. Correct. Deferred tax, not forget asset. Deferred tax concept itself happens only if there is a temporary difference, which will get reversed later on. So if it's a permanent difference, means there will not be any deferred tax implication over there. Now we have to find one more. There have been previous years of significant profitability. This previous year significant profitability and now you have made some losses, it means you can create some deferred tax asset, because you have some hope that in the future you can make that profits once again and claim these tax losses against it. So that was one of the criteria for carry forward of tax losses. There should be some probability or some indication that company could get back into profit situation to utilize these tax losses. So second one is an indicator that deferred tax asset will be recognized, so that is out. There is a history of recent losses. So if the company has been making continuous losses in the recent years, that means it's also an indication that in the coming years also, there's not very much chance that you will become very profitable where you can use these tax losses. That means you cannot create a deferred tax asset. They want non-recognition of deferred tax asset. So this is also one option. So we're done. Last one, there will be sufficient future taxable profit against which the loss or credit carried forward can be utilized. So if it can be utilized and sufficient some indications are there, then you can create a deferred tax asset. So read the meanings carefully. Just because option B and D are the true options, don't directly go and select that one. They're not asking for the true options, they're asking for the false options. Non-recognition. What can lead to non-recognition? So hope you understood the meaning behind this question, and we're done with question number 30. And I guess that was the last question. Yeah. So that was the last question from section B, and with this, we are done with this complete paper of the pre-mock for June 2025 sessions. Hope you have enjoyed all the way till here, and hope all your preparations are going well, and hope these videos have been helpful in your preparation as well. Just one last time, make sure to share these videos to your friends who are preparing for the same paper. Make sure to subscribe to our channel for more such amazing videos where we'll be solving more question papers and some other contents as well. Make sure to follow our Instagram channel for our weekly reels that will be helpful for your preparation to get some basic understanding for the topics. And just like every YouTube video ends, make sure to subscribe, like, comment, share everything. And yeah, best wishes for your exam and good luck. See you soon. Bye bye.